Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property finance and money management. Hello, mate.
G'day, buddy. How are we?
Very good, very good. Hey, today is Q&A day.
So glad we're at Q&A. I mean, mind you, the guests we've had, incredible, right? You know, learning so much from those guests. But it's just good to get back to Q&A.
Get back to the basics.
Get back to the basics. Keep telling, teaching, keep teaching, keep teaching.
Well, it's been an interesting sort of month, isn't it? Greville Pads.
Yep.
We've had TPC Live in Melbourne. We've had Mark McCrindle. We've had...
He was wonderful. Greville, everyone's good. Everyone we have on is obviously worthy of being on it, because we wouldn't waste our listeners'
It's been a while since it's been me, you and Stig in here on our own, isn't it? So let's get this started. So today is the People's Day, Ben.
Yep. People's Day.
The questions are the People's Day. The
Beautiful.
Mindset Minute is the People's Day. LifeHack is for the People's Day. And mate, you're off the hook.
I'm off the hook.
Did you know?
It's
also the People's Day. So
thank you, whoever, because I haven't obviously heard these questions.
Correct.
So
You're about to find
I come
out.
in a little bit. Yep. Okay. What do we got?
Okay. So Mindset Minute today from an anonymous person.
Okay.
But they're a Zig fan, Ben.
Okay.
So Mindset Minute is: the more grateful you are for what you have, the more you have to be grateful for. Which is another one of his good ones.
Yeah.
Do more than what you're paid to do, and eventually get paid for more for what you do.
Yes.
So it's just these little flips.
Love it. Very good. So thank you, Anonymous.
Thank you, Anonymous. The more grateful you are for what you have,
Zig Ziglar,
the more you have to be grateful for. All right, Ben, today let's hook straight into it.
Straight in. Lots of questions to get through.
Now, I'll tell you the name of this person, Ben,
Yep.
but it's quite a difficult name.
Rightio.
And at the beginning of the question, he answers it for us. So Here's one straight away. Let's cut to it now.
Ben and Bryce, my name is Krollis, and firstly, like I said, I absolutely love the work you guys are doing. Keep it up. I've got a few quick questions. Forgive me if they're a bit dumb or novice. First one, if purchasing a second or subsequent property, can you have more than one offset? And if so, do you split your money between them? Or is it wiser to put all the cash into the offset against a larger loan? Second question has a bit to do with location score. Now, I've gone through and created a sheet with all the suburbs within a 15-kilometre radius of the Brisbane CBD, and found that most of the better scored suburbs are actually quite far and don't meet a lot of the criteria you guys talk about in terms of asset selection at the suburb level. I understand that the location score is essentially a demand versus supply score, so for strategies of buy and hold, are suburbs that are classed a maybe but in better locations still a good viable option? And the third one is just in terms of a process when purchasing a property. Would you be able to run through a quick step-by-step in terms of what happens and when, such as research, when you get your loan approved, building and pest deposits paid, etc. I think this will be a great help to first-time buyers or those that haven't purchased in a little while and actually can't remember the steps. To all the listeners, if you aren't PICA members already, get onto it. I was at that first meeting in Sydney and it was absolutely great. Go the Swannies. Sorry for the long question. Thanks, guys.
Krollis, thanks very much for the questions. They are great. So I'll start with the first one. The more than one offset question.
Well, you missed the important bit. The fact that the Swannies just beat the Collingwood recently. So he said go Swannies at the end of that. So we should have acknowledged that.
That's past.
That's a few weeks ago, but it was still good.
I've almost got it out of my mind completely. All right, so first question about multiple offsets. So one of the big technology changes that are happening from a lending point of view, from where we were, say, 2 or 3 years ago, is a lot of lenders are introducing multiple offsets. A couple of things with offsets. You need 100% transactional offset, not some of these crappy offsets that do an average, work out the average of what you had in there in a month. It's 100% transactional, daily interest saving offset. Now, some of the banks, as I said, have spent a lot of money on innovation, and what they've done is they're now allowing you to have multiple offsets if you're a professional package customer or so forth. Now, some of those offsets, some banks have limitations, right? So the first one is you can have a loan A and you have one offset against loan A. Then you've got loan B and you've got one offset against loan B. The new products, and if you're listening, bankers, this is where you need to be at, because this is where the future is right now, is that you need to make sure that if you do offer multiple offsets, they can point to one loan account. Really, really important. All right, because I do not want you spending your money and spreading your money across multiple offset accounts. Under the Money Smart system, there is only one primary offset account. Primary meaning singular, not plural. So the idea behind that is you must keep all of your money in that one offset. If that offset is full, then you move on to the second offset. Now, there is a little deviate to that in terms of a caveat to that around that if you're using the Money Smart system and you can point more of those offsets to your one loan account. So in other words, we've got loan A and we've got maybe offset 1, 2, 3 all pointing to that. Then I will give you the exception where you can maybe put some provisional money aside, or you can name some of those offsets that they can't be touched. But primarily, one primary offset, all the money flows into that, and then you've got obviously all your other elements of allocations and segmentations under the Money Smart system. If you want to learn more about that, you've only got about maybe 6 weeks to wait before our book is out, which has all of this information in it in around how you set that up. But I do not want to see any money in any other account other than that primary offset, and I want it pointed at your non-deductible debt. I want it pointed at your principal place of residence.
Well, isn't the framework pointed at the most expensive debt you've got in the portfolio? Because at first it's the non-deductible debt, and as soon as you've paid off the non-deductible debt, you then go and look for what is the next most expensive.
You make a really good argument there, Bryce. If you were, let's say you're self-employed and you had got sort of, let's say, private funding, right? You couldn't get lending through the traditional sources, and your investment loan was like 8%. Then you would actually argue that it's better to have the offset or pay that loan off before it is paying off your principal home. But the differential at the moment between investment lending and owner-occupied lending, it's far better that we point that money towards your non-deductible debt, even though, Bryce, at the moment, if it's P&I non-deductible debt, you're getting that money around 4%, maybe a bit more, and then your investment lending is around, say, 4.6% as an example. You'd be thinking, well, you know, why wouldn't I pay off the highest debt first? You don't, because obviously when you've got the money in your offset account, it's saving you interest on your non-deductible debt.
Yeah.
So that's where it becomes.
So it's not about loan size; it's about the cost of the funds.
Yes.
And
the nuances of that.
Because even if it's interest only and it's higher than the rate you're paying on your own home, you're getting cash flow incentives because of the tax advantage from it.
Correct.
And you don't want to change the nature of the loan when you've got non-deductible debt on the home.
So that's
the point is, it's like this little worm trying to find.
Yeah.
So it's not the largest loan. It's not the most expensive interest rate. It's actually what's the most financially advantageous for you to do, then park the money against that.
Yeah, and as I said, if your cost of funding for your investments is extremely high, there may not be an advantage in pointing that money towards your principal home, because even with the tax deductions that you would be getting, it may not be as advantageous. But the general rule is at the moment it's still cheaper to point your primary account, your offset account, your 100% transactional account at your non-deductible mortgage, and keep your other loans interest only. There we go. So, but don't have all these fancy splits and all that if you don't need them. Money Smarts is really simple: primary account, living and lifestyle account, and also credit card. That's the banking structure. In terms of what sits inside that primary account, it's really simple. You've got your 7-day float living and lifestyle, you've got your loans jar, you've got your provisioning jar, and you've got direct payments coming out of that, and your credit card jar. So really simple stuff, but more about that in the upcoming book.
Well, you're so passionate about it because we've been knee deep in the book getting it ready this week, so it's fresh, front of mind.
It is. I've definitely, I think in terms of when you've got so many nuances and you're trying to structure it the right way and make it easy for people to understand, because we're building an app behind this too, Bryce, and letting everyone know. The book is more complex than the app because the app does all the calculations behind the scene, but the book needs to step it out in a process. All right.
Stay tuned. We'll let the listeners know about the app.
More about that later on. Location score. So location score, and this is a really, really good question. Remember, location score predicts the supply and demand of an area over a shorter period of time. All right, so that's what it's designed to do. So when we're finding that we're getting higher scores in the outer suburbs, that is logical for where the time of the cycle is in some of these marketplaces, where they're more affordable, and we know that first home buyers are in the market. So property prices over the shorter term, in the outer suburbs are actually outperforming some of the middle and inner city areas at this time of the cycle, Bryce. But it's that ripple effect. It's that effect of where it comes from, because the land that underpins the value starts at the centre. So what we are seeing is, because of these price points and these properties being unaffordable at that inner and middle level, is over the last couple of years, you've got an outperformance from a percentage growth point. But we say to that is, if you can keep using the research, so keep using location score and identify those areas that may not have the very highest score, but still have good, strong demand with supply, and you can come a little bit closer in, then that's really going to be of value to you. So it's an early level tool, and that's why it's so effective. If you went into those outer suburbs, Bruce, you might still get a 20% run, and you're thinking, well, that's pretty good. And if you're an aggressive investor, that's all you want, because you want to be able to release that equity. But the world has changed. Finance is more difficult. So we would always be saying, follow that train in and have a look at those price points that are a little bit better, or the land is in tighter supply, the area is a little bit more affluent. If you can use location score and put our overlying principles on that, you can find the gold inside location score.
Oh, good point. Because what I was going to say, the way I use location score is you've got two parts. You've got technical and you've got fundamental. So the technical, that's the key indicator to put suburbs on your radar.
Yeah.
That means that it's the safety net to make sure that you wash away the other ones that should not be on your radar. And then I overlay fundamental, because as you say, for our clients, we're get rich slow. We're not get rich quick. So we actually want to play the long game. We want to play the 10, 15 and 20 year game. So not only do I want to know where demand exceeds supply in the short term, I actually want to overlay that with the fundamentals to make sure that I'm keeping an eye on where it's going in the long term. But some people, Ben, they want to be in and out.
Yep.
They want a short-term trade.
Yep.
That's perfect for them. So,
short-term trade, anyone who's flipping, renovating for profit and is getting in an area that's growing at that time, that's where they'll get that, so they're more the active investor rather than the passive investor. That's exactly what will happen, because what you'll find, and if you think about this logically, once this cycle's done and the world settles down again, where does the value start from? It starts from the centre out the next time around. So that is always the core. That's cause and effect. So the cause from our point of view, is that the land value appreciates from the inner area and moves out. There's no evidence to suggest that properties in the outer suburbs will ever surpass property values in the inner suburbs. There are random little events, like one little pocket in Melbourne with a very high Asian community, where it's been a little bit more interesting in terms of, because there's been this demand, and so it's quite odd.
Concentrated demand.
Yeah, it's a concentrated demand of a certain market type, which puts you at risk if you're not in that market type. And if you're thinking they're going to rent, no, these people, the Chinese, normally buy. They don't like to rent. So the reality is that we see a very tiny drop of value from this high concentration as we point back towards the city. So but that's it. I haven't found any other areas around. And you also get some type of gated communities every now and then. So it's an estate that it's a gated community, and you've got larger land sizes where they're selling.
Golf course.
So areas like Research in Melbourne and some of the outer suburbs in the hills districts of also Sydney. So you get and also just up in the hills district of Brisbane, where you get these estates that are on acres, 1 acre, 2 acres, and the houses are really extensive. Plenty in Melbourne as well as another one that comes to mind. They are exceptions to the rule, because they're not suburbs, they're communities, and they're being subdivisions, and they're being tailored and developed to attract high net worth tradies and all that to go to those areas. But if you take a blanket approach, what you'll find is the normal middle suburban, outer suburbia residential subdivisions en masse, they will never ever surpass the value of the stuff in. So the growth always comes from in and moves out.
So Krillis, taking that into account, the framework for you to overlay is keep using location score as your leading indicator to work out suburbs, and then overlay human interest, human behaviour and economic activity.
There it is.
Merge the two as a superpower.
Yeah. And so, it sounds like you're getting it right in terms of finding this little pocket that you want to look at. So by playing the long game, you may not get that, that rush of growth that we're seeing in the outer suburbs right now, but I promise you, and if you look at some of the data dives that we're doing, and we'll share some more of that how-to data dives that we're now going to start producing, you will see the history will show that it starts from the centre and it works itself out over the long term.
Well, mate, you've recently done a data dive. Maybe we should let's share it.
I would love to share it. It sounds like a great idea. All right, get it. Ivers, can you do that for us? Whack it into the show notes.
Yep.
And check out what I'm talking about in terms of this long-term performance versus short-term performance.
Let's remind those people who have joined us just recently, Ben, in our community. The show notes are just tap the photo on the podcast, and behind it appears the show notes.
Yep.
And that's where the link will be. So
fantastic. And so there is some real gold in that data because that's telling a real story. Now, Bryce, your last one.
Now, the process for the purchase is very simple. You've got to overlay a couple of the frameworks we talked about, Ben, the 5 steps. So we've got clarify, evaluate, implement, plan, implement, and manage.
Yes.
So that's still the same. So first of all, if we go way back, we clarify what it is that you want. Because people say to us, do you buy just capital growth properties? No. We are not a one-trick pony. It is whatever you require. Do you need a growth asset? Do you need a balanced asset? Do you need a yield asset? And the only way we're going to know the answer to that is if we clarify what you want first. Okay? So when you're buying an investment property, Ben, so clarify, evaluate, plan, implement, and manage. I'm going to go straight to implement here because that's what we're talking about.
Yep.
In terms of the implement, I tell you what a buyer's agent does. They do 4 things. They further clarify the brief. They go and find it. They then go and assess it, then they go and negotiate it. So what they do is they clarify what it is that you want based on what we just talked about. So do I need a higher yielding brief? I've got land tax issues in New South Wales, I need to buy outside of that. There's a whole range of things that form the foundation of what we do. We then go and find them, whether they're on market, Ben, which is easy through the portals.
Yep.
And then the other one is off market, which comes from relationships.
Yep.
And buyer's agents have relationships that the general buyer doesn't necessarily enjoy. Then we've got to assess it, Ben, against what we've found, against what we've clarified. So sure, this is a great property that will grow in value, but is the shortfall so great that I won't be able to hold the property longer than 18 months before I tip over? Or vice versa, am I a shoe-in with the cash flow that I've got? And then the final thing is, do you then negotiate, whether it's at private treaty or at auction? So if we flow that through, all right? So first of all, we always say to the client, we're never in a hurry to find a property, but when we find a property, we are in a hurry, all right? Because there's a window of time where the anxiety is really high, where where the agent's back and forth, we might be up against competition. So anticipating that there's 2 parts of anxiety in the whole timeline, that's one, and one's a bit later, which I'll talk about in a sec. So what we need to do is reverse engineer all of the things that are going to happen in that 48-hour window and make sure we've got it prepped. What name's going to go on the contract, Ben? Have we asked our accountant? Is it in a trust? Have we got our pre-approval in place? Is our equity release? What are we going to do for a deposit? Are we at high LVR, which means we've got to be conscious of the fact that if we're at LMI, are there certain properties that we need to avoid? So we need to be asking lots of key questions that are happening during that anxiety period, way back nice and early, to make sure that we've got that sussed. Once we've got the equity released, once we've got the finance pre-approved, we are in a very strong position of strength, Ben. So for example, in Melbourne, you have to be pre-approved. In Brisbane, you don't. In Adelaide, you don't. So it's important to know, if you're buying in Melbourne, you need to have your ducks lined up beforehand. If you're buying in Sydney, you need to have your ducks lined up beforehand. If you're buying in Brisbane, you can do your due diligence afterwards. But in a competitive market, we would say bring Melbourne and Sydney paradigms into that market, because you want to be able to make an offer on a property, make it attractive to the vendor, because if you're one of 3 offers, make sure you do that. In Adelaide, for example, you make an offer and you don't even have to make it subject to any conditions, because they give you what's called a Form 1, which means you have a certain period of time on the spot, I think it's 3 days, that you've got midnight on the 3rd day, which is, if it's not 3, it's 5, because there's so many around the country, I'll double check that. But as soon as you've been issued that Form 1, Ben, that's when the cooling off period starts. So what they normally do, it's actually 2 days, Ben. It's 2 days. 2 days. Come back to me.
48 hours.
So then what happens is what you do is you ring up your builder and you say, right, I need you to get through in the first 2 days. It's a culture over there. They know. And if there's something wrong with the building, you cool off, Ben. So you've got to make sure that during that window of time when you're about to buy, there's lots of anxiety, so you need to reverse engineer lots of key questions back at the very beginning. Are you someone that likes detail? Are you someone that likes to get it done? Are you comfortable with auctions? You need to know all this sort of stuff. Once you've got a deal done, Ben, you've got to have your builder lined up, because if it's in Brisbane, subject to building and pest. If it's in Melbourne or Sydney, you've got to have the builder lined up beforehand. You've got to have your solicitor in place to make sure that you get the contract checked out beforehand. If it's in the other cities, you get the contract done afterwards. So making sure that we have these things in place so that we know. Now, you need to know how to put some clauses in, and in some states you need a licensed person to put some clauses in, so make sure you've got that in place. Then as you get closer to unconditional, the property goes unconditional, you've satisfied building and pest, you've satisfied finance, you then move into overdrive, which becomes the second most anxious part of the whole timeline is, okay, we've gone unconditional, Ben, now I'm nervous about whether we're going to get a tenant. What happens if we don't get a tenant? What happens if we don't get a tenant? So you need to be interviewing property managers in advance of settlement. If you've done the negotiation well, you've negotiated to get access to the property prior to settlement with the property manager so they can get a bit of a run-up in, so that you can minimise the window that you have as a vacancy. You need to interview property managers. You need to ask them key questions to make sure that they're not just giving you lip service as to the fact that they are going to give you a good service. What you do is you give them a call and wait for how long it's going to take for them to call you back, because that's indicative of their service levels. So you've got the property manager in place. You've got that lined up before you settle. Ben, you've put out the call to make sure that you've got landlord's protection insurance in place. So that's in place. And you've given the guys, the quantity surveyors, a heads up and say, hey, look, I need a depreciation schedule done. Now, the reality is a depreciation schedule doesn't need to be done until 24 hours. It doesn't need to be in your hand until 24 hours before you're going to meet with your accountant and lodge your tax return. But I always say get it in early, Ben, because it's a nice little surprise if you're a first-time property investor to see, wow, I'm getting all these non-cash deductions. It's pretty cool. I can actually get some tax back from paper deductions, which is nice. If you're an experienced investor, Ben, keep the money in your offset account, get it at the last minute.
Love it. Well, just make sure you get it before 30 June.
Yep.
Because that obviously will give you that year, or the year that you bought it in will secure that. So that's a good one.
No,
so
that's about lodging your tax return, not when you get the report.
Yeah, that's right. You can get the report. But as long as it's before that end of that financial year, it helps you, because it can go 2 years backwards depending on how long you've had it for. So, Matt, I've just made some notes whilst you've been going through that. But I've also been listening intently in terms of what you've been saying, right? So in different states, it's obviously different timings for different things. But I've just gone and said, right, step one, cash flow, affordability. That's the first thing you want to make sure. Step two, get your finance in order. Step two, get your 22, get your finance and borrowing power sorted out. Step three, know which name you're going to put the title on. So if it is an investment property, there might be tax consequences around that. So you want to have a chat with your accountant in terms of what their views are in terms of ownership and what that looks like. Step four is effectively finding the property in terms of making sure that once you've found it, you also talked about a building inspection there. You also talked about a contract review with your conveyancer or a legal person. You've also talked about when you're negotiating, you want to have those contract terms to make sure that they're in the contract before you buy it. After you buy it, you then got the property manager, and then you've got the defence, which is the insurances around that property, and then you talked about the depreciation. So there was, and some of those are slightly nuanced in different states, which is what you were trying to highlight there, but that's probably not a bad little framework in terms of stepping through that.
Love it. And between step 2.5 and step 3 on your page there, it's location does 80% of the heavy lifting.
Yes.
Make sure you focus on suburb first before you go to property. Because if you've made the decision, I am going to buy a house, and I will buy a house that no matter what the cost is, I think you've got the
barking up the wrong tree. Thank you,
Krillis.
Thank you for those questions. They were terrific.
All right,
and the PICA mention. Thanks for coming along to our PICA meetup. And if you're not a PICA member, come on. We're there. We're here for you. Get involved. $5.
Hey Ben, I'm wondering too, for the listeners, if they're wondering, oh yeah, someone else will do that. It's you've done it at a price point that makes it easy for everyone to give their $5, because it then gives a voice. So don't suffer in silence as a property investor, because if depreciation changes, travel changes, all these things are happening because you don't have a voice. So if you're sitting there thinking, I hope everyone's getting on board. No, I'm on board, my wife's on board. We're saying to you,
we're heading
jump
towards
on board.
that 1,000 membership mark. We're getting closer and closer every day to that 1,000. But you're absolutely right. So whether it's negative gearing or capital gains changes, but what about credit? What about credit policy? Like if we were united, and there were literally hundreds of thousands, because there's 2.2 million of us out there. If we were united and we had enough say, the banks, the lenders, the regulators will listen to us. Right now, we're just spread out amongst the community with no united voice. Bringing everyone together gives us that critical mass to have influence about the ultimate price of property. You know, is it fair that property investors have to pay more for the money that they borrow when they're more reliable at paying it back than owner-occupiers are? So we're getting penalised. That's not fair. But one person complaining to one member of parliament, one person complaining to one bank means nothing. 200,000 people complaining about high interest rates for mortgages. What are you going to do about it? Gives us real power of influence. And that's what PICA is all about. We're all about advocating for the benefit of property investors. In fact, we're advocating for the benefit of property owners most of the time anyway. So that's the point I'm making here. But if I don't have your number as a member for $5, then we don't have an opportunity to get that united voice. The politicians will look at their number crunches and they'll say, oh, politically, this is not a nightmare. But if they saw us all together and they saw that we were united and we had our communication right, they would say, before we do this, we've got to be realised of what this will mean for these voters. Right? But they don't care about us now because we don't have that united voice. So if this isn't inspirational enough for you to give us your membership, please do so. It's going to be really important because they'll come after us, right? Apparently we're super mega rich property investors now. So they'll look at us and say, politically, we can get this job done. So let's do it. Let's tax them higher. Let's make it harder for them. Let's change the Tenancy Act laws. Let's do all these different things because we haven't formed a united group. And that's what PICA is all about.
It's not about your vote. It's not about your money. It's about your vote. It's about the power of the person behind, which gives us clout. Because you don't need the practice, do you, mate?
Get up there and tell politicians what they're doing wrong. No, I've got a few.
No, but I mean, in terms of you're not doing PICA for anything other than to create a movement of people that'll allow you to have a voice. It's nothing else. I mean, $5 is it's not a lot of money in the bank.
And
it's
a lot of my time.
Voice. Yeah,
a lot of my time because I mean, obviously we have thousands of clients who own investment properties. So I'm doing it on their behalf, but I'm an investor myself. I'm doing it on my behalf. I'm doing it on protecting the valuation of properties. If we've gone out and borrowed money to get a return on investment, I'm doing it for that reason as well. So I'm doing it for everyone who's listening to this who wants to be a property investor, who already is a property investor, because the reality is that they will see us as a means by which they can tax us higher. They already tax us extraordinarily when it comes to stamp duty and all of the other associated land tax, all of the things that we're paying for, okay, to get this return on investment. So the reality is, if we can get a community that's large enough to have influence, then all of a sudden we'll be at the table. We'll be able to sit down and say, well, what's your policy here? What's your positioning? Why are you doing that? Have you thought about this? At the moment, that's what the mining industry did. When the mining tax came along, they all went, we've got to do something about this. We've got to do a big PR campaign of how great miners are. And they stopped the major changes around the mining tax. We can potentially have the same people power to basically make changes for the good of society, the good of our investments, because we don't want macro-prudential changes coming through, Bryce, that is going to, it's a bit like saying you go and buy that thing and now you go and buy a license and then the government says there's only 10 of them, so you pay an absolute premium for them. We're just going to release another 100,000 licenses. So all of a sudden, you should have told me that in the first. You go and change the game and it affects us dramatically. That's not what we're interested in.
So the call is very clear, Ben. Click the show notes,
Yep.
go through, register for $5.
$5 or 20 for 5 years.
Yeah.
I just want your name.
So folks, I'm not involved with PICA other than being a member. I'm not involved with the running of it as Ben is, but I'm pleading to you, if that what Ben just said to you resonates, please click on the notes. Please register so that you do have a voice in PICA. So
for property investors, run by property investors.
All right, Ben, let's cut to the next question. This one's from Cam.
Hey guys, long time, first time. I'm currently in the market with my partner to purchase our first home at the age of 27. We have saved $100,000 and in our third year of full-time employment with a combined income of $150,000. Would love to purchase a home within our community of southeast suburbs due to work, sporting clubs and families. However, our question is, Should we be stretching ourselves to purchase a property in the area we love first, or should we be buying an investment in hope to build and use equity to purchase a family home down the track? Thank you.
Good question, Cam. You said southeast suburbs, making an assumption that it's
Might
probably
be the Leafy East
Melbourne.
or somewhere around that area. So, hey, long time, first time. Thank you, Cam, for reaching out to us. We really love it. And good on you and your partner for saving $100,000.
At 27.
At 27. It's a good story. Good, nice household income there. So I put it back to you, Cam. So if I was sitting down and we were having a chat with you and your partner, the conversation would go deeper into the motivations around what's important to you. All right? Because I know that I can get you an investment property. I know that I can set you up as a rent investor. I know that there's ways in which I can make you money. But if I show you that buying an investment property now is going to limit the prospects of you actually getting that dream home sooner rather than later, that may not be palatable for you. That may not be a situation that you feel comfortable with. So my first driving message here is putting the big rocks into the jar means that, if that's the area that you want to live and we can afford to get in there, that's going to give you a house and that you can make a home, whether that be a large apartment or whether it be a townhouse or whether it be a freestanding property, the reality is I'd prefer to do that for you because we know the cost of not scratching an itch. The cost of not scratching an itch is you could potentially get into an investment strategy and then all of a sudden your priorities really do bring home the fact that you want your own property and we have to sell out of that and the market's been flat, you may actually experience a loss. So it's not always about getting that investment property first. Good incomes, get your foot in the door, you're only 27. If you wanted to create wealth and that was the most important thing for you, rent investing would be something we would consider.
Well, I was about to say rent investing is the option, Ben, but one thing that people don't understand about rent investing is if you change your mind into the rent investing program, it can come unstuck pretty quickly because you've operated under a bunch of assumptions. Because if you then change the plan and throw a non-deductible debt into the picture, and for most people it's usually more ambitious than what they've got on the investment property purchases, it's actually not that straightforward, is it?
No, it's not, because what's happening, Bryce, is if we have to wait 5 or 6 years to get into that next property, that property is growing in value. Okay, so the compounding value of that property, and usually if it's in a good location, it's growing better than most other areas. That's why we want to try and get into that location as early as possible. Now, an option could be that they do buy a more significant asset by having it as an investment first. So they keep renting where they are, or they go and move back home and spend 12 months maybe, in the extended part of mum and dad's home out the back. So they've still got their privacy, or, their parents are going around Australia for a year and they can look after the house. Then buying it as an investment for 12 months or 18 months, not a bad option, right? Because, and then they might buy something that needs a bit of tidy up and renovation, then they can move into it, tidy it up, and then release the equity and go into their investment portfolio.
Yeah, because it did say that it would stretch them, so as long as it stretches them comfortably rather than uncomfortably. So.
Correct. So there's 2 or 3 options there, and that's where doing the number crunching, sitting down with someone who can help you identify what really are the most important things in your life. And this is what we talk about with lifestyle design. It is about when you get to the deeper drivers, the internal drivers of what's going to make you happy and what's going to give you fulfillment, you can then start to line up the importance of money. Because money is not the reason we get out of bed every day. That's the secondary component in terms of having enough to do the things that we want to do. And it will never buy you true happiness. You connecting with those really important things and those personal motivators and drivers that are going to give you fulfillment, you'll then work out, okay, you've answered my question. I now want to buy an owner-occupied home. I will stretch myself a little bit to get into the pocket that I like. Terrific. And we'll circle back for that investment property at 32. And that's completely okay because you've got your money into a nice asset. But if you are, no, this is all about retiring earlier and we don't care, we're flexible, but it sounded like he cared. He told me about his community, he told me about his sporting commitments, he told me about everything that makes living great. I don't want to change that for him because you change that, you change everything around that story.
Big rocks in the jar, Cam. Thanks very much for your question. This next one, Ben, we'll cut to is from Sonia.
Hi guys, loving the podcast. Lots of talk at the moment about the risk of Australians switching from interest-only loans to principal and interest. I'm currently paying interest only with no option to refinance because I'm starting up my own business and not currently working otherwise. Half my loan is fixed, the other half is variable. My question is, should I pay down the principal of my investment property while the interest rates are low to control the risk of both a higher interest rate at a later date and the principal and interest amount that I would have to pay when my loan switches over? I am interested less in the tax advantages and more interested in controlling risk and reducing my overall total repayments and my individual monthly repayments. I know that the longer my interest-only period is, the higher my repayments will have to be when it switches over, and yeah, that doesn't sound great to me. I'm sure this is of interest to your other listeners, so hopefully you'll have some insight that you can share. Thanks again. Loving the podcast. Speak to you soon. Cheers.
Hey, Sonia, thanks for that.
Yeah, there's some complexity in this one, Sonia, because there are little things that I would want to know a few more things about, and they are, is this an investment property? Is it an owner-occupied property? I also want to know how many more years you've got to go on your interest-only term, because I got a little clue in there about you starting your own business whilst also working full-time. So I get that, and so what are the projections on the business in terms of how quickly do we think it's going to take off? And when it does take off, what sort of income are we going to have when it does? Because they are going to be some of the little nuances that would take me into different recommendations. But with the information I've got, I'm going to be quite general, okay? And I'm going to talk about the concept of controlling money, because what we were talking about there was this concept of pay down, because you're thinking that if I pay it down being an interest-only loan, that means automatically my repayments each month will be lower. Correct. But what if I said to you, because you had a 50-50 split, I don't know how much money you've got in your offset against your variable, so I'm hoping you've got an offset against your variable. If you don't, and it's a principal place of residence, and it's not going to be an investment property down the track, then pay that surplus into that loan and reduce those repayments if that feels comfortable for you, because that's going to be the best use of your money for now, because we can always redraw it if we're in advance. But if you have an offset, we do not want to put the money into that account. We want to keep that money liquid. And by liquid, we mean keeping it in that offset. So you can still be paying those minimum repayments, but getting the benefit of having the interest deductions every night being lower because you've got that money in the offset. So for me, it's about sort of saying, get all of that money over here. Now, when the time comes when you are going to be called to switch to principal and interest, well, guess what? That pool of money that you've got sitting in your offset account is going to give you some time. It's going to buy you time because those extra repayments that you're going to be making are going to be drawn off that surplus cash that you've built up. So that by that time, hopefully your business is doing better, and you've also got the choice to potentially refinance to a new lender where you might go back to interest only or to stay principal and interest based on your circumstances. So it is a fascinating question, and for every household, there are those little bits of information that we would need to form an opinion before we can give you actual personal advice. And this is credit advice, so it needs to be delivered by a qualified and licensed mortgage broker. No one else. You could potentially get a financial planner. They are qualified to give some guidance around this area. And on occasion, maybe the accountant might be sophisticated enough. But for me, investment savvy mortgage broker, a clever mortgage broker who can see your whole story is where you're going to get those answers, because we revert back to always being in control of liquidity. Because when we're in control of it and it's not in the bank and the bank locks it away from us getting it, we can't control our outcome. When it's in an offset account and we can drip feed it into paying, that gives us a greater amount of time that it's going to buy us for those circumstances to change. And we might even see lending standards be slightly relaxed from the sort of tightening that we've seen over the last couple of years. So that's the story. Lots of moving parts. I love the question. I'd love to know more about your situation so I can be more specific for you. But you can understand that I'm all about controlling that balance in a higher offset account and drip feeding that money as I need to drip feed it.
Gold alert. Rewind, listen to that a couple of times. Gold alert. I don't have anything to add because you covered off all of the basics there, Ben. But I think that's I think what's important about Sonia's question is I think that's on the front of a lot of investors' minds right now. So
yeah, well, I agree. I mean, there's going to be investors who have built up large portfolios all on interest only. In the planning stages of when those interest only terms materialise, if you can do some forward planning now with your broker. In terms of saying, because if you've got 2 or 3 loans that are coming off interest only to P&I, that is a cash flow crunch like none you've ever seen before. And in a lot of cases, you may have to, if you've been too aggressive, you may actually have to sell a property if you can't find an alternative solution. So those alternative solutions, don't wait for the last 6 months to try and find them. If you know that you're in a cash flow crunch that's going to come up in the course of the next 2 or 3 years, I would be planning that out with my broker now to see what options there are right now. Now, he might come back and say, nothing right now, but now that I know the case and I've got this window of time, I will be able to revisit this in 3 months, 6 months, and when I know that there is an opportunity for us to do something, or, here's what I need you to do. Go and get a second job, stacking shelves of coals, just for this, whatever it may look like to get us through that. Because what we are talking about here is any type of new lending is now what we call credit critical, which means that it's going to be reassessed by a lender unless you're switching back over to principal and interest. So this is a time where expert advice shines, and getting all of those ducks lined up and speaking to someone professionally is going to hopefully, for those more aggressive investors, save them from materialising and liquidating a property when they didn't have to, and hopefully get through this tight period, but coming out the other side as well.
And Ben, we were chatting before we went to air that the days in the current environment of people buying multiple properties is very, 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 very difficult to do. So it's now a good time to have a look to see what your strategy is. Does it stack up? Are you a retiring debt strategy? Are you a liquidating property strategy? Are you a debt servicing debt strategy? Because that one in particular, the end one, it does work on paper, but in the current environment relies on 2 things. Optimal and continual exponential growth, which we're going through a flatter time, and making sure it's not difficult to access credit, which it currently is. So that's what creates a challenge on that particular strategy.
And we always talk to people about having a 12-month minimum buffer. 6 months if you're high risk, high reward, but 12 months as a minimum is a good standing, right? Because there's other things we can do. Remember, 4 levers: income, expenditure, time and target. So what we've also got to revisit is, what does our discretionary spending look like? So what are the consequences in us tightening up and just going essential spending for 12 months, okay, to retain that asset? Because we don't want to be a seller by force. We want to be a seller of choice, right? So when's the worst time to sell? When everyone else is being a seller of force. Where you're being pushed to sell, because that's when you're not going to get the best result for your property. So from that point of view, there are lots of moving parts to this story. That's why you need to get some professional advice.
Very good. Thanks for those questions. We had one from Sonia, we had one from Cam, and we had one from Krillis. Ivis, just make sure I got that pronunciation right. All right, Ben, so I've actually got 2 life hacks. Here comes the first one.
Yes.
It's from Nick. Nick sent this one in, Ben.
Oh, which Nick do I? You looked at me like I meant to know Nick.
Well, you don't know Nick?
I know a few Nicks.
His name's Nick Carpenter.
Oh, he's a carpenter.
He's a carpenter. It could have been Nick, Carpenter, or it could be his surname. We don't know that. But Nick said, to make this time most productive and give you the best chance of making the most of the hours you're awake, get the best mattress and pillows you can afford, Ben. Man after my own heart. Hey. Because you mocked me a little bit about the fact that I travel with my pillow, it made a difference, because I recently went up to the Sunshine Coast, Ben.
Yep.
And I was only taking a little carry-on bag because it was only a sort of a 48-hour experience. Yep. Couldn't sneak the pillow in, Ben.
Oh.
It was a rubbish night's sleep, I've got to tell you. It was robbing Peter to pay Paul. So there you go.
So can I just make one comment? And, it's all I can say, my reference to pillow for you, soft. Just soft.
Mate.
I mean, come on.
Mate, at your age, you should be thinking about these things.
I wake up
Get
with
a
a
better
sore
night's
neck.
sleep.
I go, I'll live with that. Soft. Guys.
Exactly.
Come on, take
Actually,
a pillow.
mine is firm. Don't worry about that. So that's a good one, Nick. So,
It is a good one.
And
Thank
I
you,
want
Nick.
to
That is good.
hear from the other folks who, the other 80% of the people that actually do take care of themselves.
Told you the only
Because the 20% who don't, they can sort of side with you, Ben.
I am on record as saying there's 3 important things I need in a hotel room, right? That is a good pillow, I can see the TV so I can watch my sport from bed, and some pressure in the shower.
Right.
Like I don't like a shower that's got no pressure.
Yeah.
Right?
All the needles.
Because obviously if I've got a bad pillow, I need that pressure to get that knot out of my neck.
Exactly, mate. So you mock, but mate,
I mock out of jest.
You're a 70s child, mate. You've got to take these things seriously now. Okay, all right, Ben. All right, calm down. I'll give you the second one now.
Hi, Property Couch team. Thanks for a great podcast. My life hack tip is along the lines of what you have said, Bryce and Ben. Thanks very much. It is good advice not to own too many investment properties. That's because I just finished painting one of mine after 10 years. Now I'm thinking ahead. If I were to own 10 properties, I'd have to be painting for 2 weeks every year. And that is no fun.
Well, look, mate, I mean, painting is cheap if you do it, but I'm now concurring 2 weeks for every property. That's a lot of painting.
A couple of takeaways there, Ben. You either want to make sure that you don't have to buy 10 properties. You just get the strategy right, so you need maybe just 3, 4, or 5. But if you do, you don't want to give up those 2 weeks.
Well, so here's a little tip. Remember, we use 1.5% of the value of the property for ongoing costs, right? Indexing at 3% in our models, right? So hopefully for Alistair, it's a situation of, mate, if you had factored that into the costs, you would have been all right.
All right, Ben. So we've got one. We've got Did You Knows come from the people, Ben?
Yes, from the people, from Jared. So I'm trying to read this with my new glasses that Bryce has just given me. So let's give it a go. He talks about every dollar saved is a dollar earned. Well, he says, I disagree. How crazy is this? I just made a spreadsheet to figure it out. And this is how he's come about it. So here it is. My wife and I are 26 and 28 respectively. Every dollar saved today is way more than a dollar earned by the time we retire at our planned age of 48 and 50. If I use that dollar to offset the loan, then it will be $2.93.
Ooh.
So 5% for 22 years. If I, instead of using that dollar for offsetting, if we were to invest that dollar in property, then it would be $4.62, which is 7.25% over 20 years.
Boom.
And finally, I love this, did you know? If we use that dollar to borrow money, then invest it in property, it will be $26.19. Now, he's very good, and I like Jared for his detail. That's subject to an LVR of 80% at 7.2% interest rates over 25 years, minus the cost of holding those funds at 5%. So if you were working out your own spreadsheet, that's exactly how it is. So I love this conclusion.
If you're following along at home, they would have come to the same conclusion.
Exactly, if you're following along. So we should think about that before each dollar we spend. Sometimes that cost is $4. Okay, so sometimes that cost $4 is costing us over $100 when we retire. So you do think about that. So every dollar has a job. That's basically, I talk about this in the book, the new book. Every dollar has a job. So make sure there's the consequences of spending that dollar. And he's saying, in this particular case, the cost of that would be over $100. So imagine the freedom. He talks about imagining the freedom and the choice of our money could buy us in the future if we just save that little extra now. Jared, you are a star. You completely understand the concept of cash on cash returns. Okay, that's where the leverage bit comes in. So it's really important to understand that. P.S. Keep up the great entertainment and banter. I've caught myself laughing out loud in the gym whilst listening to your podcast a few times now. I wonder if anyone has noticed. Jared, thank you very much for that. Did you know?
That was terrific. Now, Ivis, just a quick poll between you and me by a show of hands. Is that the best Did You Know segment we've ever had? That's a high five there. So it's.
Oh, mate, I'm high five. Don't leave me hanging. As I said, I'll reach out to any of our listeners. Use our, what is it called? Our voice. What's the thing?
What is it called, Ben?
The voice thing on our website.
SpeakPipe.
SpeakPipe. Use SpeakPipe. Give me your Did You Knows. All right, and then you just take one extra job away from me a week. It's perfect.
Well,
I'm very happy for that.
It is hands down the best one. So $1 saved is more than $1 earned is how to summarise that one. So you liked what you heard, Ben. So you happily made redundant here, are you?
Go back and listen to that again, because that is the understanding of how $1 spent today, the opportunity cost of that dollar is what is worked out in 3 different scenarios, including the most powerful of all, is when you put leverage, sensible leverage against that dollar and get a cash on cash return. Insane.
Don't know what was better, Ivis, the fact that was brilliance for Did You Know, or Ben was able to read that out all in one hit with my glasses on.
Almost, there we go, on microscopic copy, text, font size, whatever you call it.
Very good. Well, if you had to use my life hack from 2 weeks ago with Mark McCrindle, you would have been able to get the iPhone out.
Well,
the problem was you were reading it on an iPhone, Ben, so I'll pay you. So. Very good, great episode. Podcast for the people. Keep them coming in. Go to thepropertycouch.com.au. Leave the speak pipe. So they go straight to the top, Ben. If you leave them, we get them featured on an upcoming episode. But until next week, Ben.
Well, I'm sure you're glad that my rambling is over. So remember, knowledge is empowering, but only if you act on it.
You had a big head of steam up. I was very, very impressed. We'll see you next week, folks.
See you later.